Cash Tags time. Welcome back to Fast Market here on the Schwab Network. I'm Alex Coffey, and it's now my distinct pleasure to welcome in the co-founder of Likeful.com, Landon Swan. And Landon, happy Monday. Thanks for taking the time and joining me here. Hope all is well. What I thought we'd do, I know you got quite a few charts here. There's three of these big discounter names. Let's go one by one, kind of in the order of which we're going to hear these results if they stick to the schedule. So let's kick it off with Dollar General and what you guys are tracking here with the kind of rural convenience store. I think I could best describe it.
Yeah, so I think just overall, there's a bit of a theme going on with all of these companies is that the consumers become fairly budget conscious, and there's more of a trade down mentality, and that mentality has stuck. People are, they're spending less. They're trying to fulfill the need for a lesser price by switching to cheaper brands, and they're definitely putting essentials over discretionary. And you can see with Dollar General, their digital traffic and their social presence is actually up pretty well on a year-over-year basis, at plus 18 points. So fairly strong there. And if you look at their last quarter, they beat they beat their report. They had plus 2.4% comp sales. And what we're seeing is that people, again, they're focusing on the essential goods. And a lot of the stuff that Dollar General is doing right now is helping them. So they've got the Dolly Parton homewares thing going on. They had that 7 days of savings in April that boosted. I think they have less tariff exposure for sure. And one of the things that interesting about this chart is, you can see there was a massive sell-off in August on an earnings report. They went from 124 to 83. They've been clawing back. I think they're up around, 90, 96, 95, 96, something like that now. So they're slowly starting to fill that gap, but they're well positioned. And everything that we're seeing is that they're taking advantage of these consumer tailwinds. It looks like to us, there's a lot of upside moving into this earnings report for Dollar General.
And when we kind of compare this then to the next name, which is Dollar Tree, is it even really a fair comparison? I almost think of Dollar General more like a Casey's gas station than I do a dollar store. But I know Dollar Tree's got kind of the traditional dollar store with the namesake brand, and they also have Family Dollar. Is Family Dollar safe to kind of compare to Dollar General, or is that still quite a bit different from your perspective?
It's closer now. They're getting rid of, they're divesting that. They're getting rid of Family Dollar. So I think that investors like that. That's been a bit of an anchor. It's been really weighing them down. And so I think a little struggle there. Their stock has made a huge run in 2 months, though. They went from 60 to 90 in just 2 months, despite their last quarter kind of being so-so. Same-store sales were flat at Dollar Tree, up slightly at Family Dollar, and the core consumable categories are doing okay, but the discretionary is really struggling. I think they've got more tariff risk than Dollar General, just generally speaking. Right. So that's a concern. And when we look at the data for them, this you can see it here. I'll quantify it though. They're at -7. So -5. So the same number that Dollar General was at plus 18, they're at -5. So a little bit weaker on the digital side and the consumer sentiment side. And we think that this run here is giving us pause. At 60. It looked like a deal. At 90, it looks more fairly priced, especially since that, plus 50% in 2 months, and the data just doesn't really back up this strong of a run.
All right, let's look at all of them kind of combined here. If we could pull up that chart that they have, guys, in the back from Likefolio, where it compares kind of 6 names within retail. And I love that you guys added in Walmart, Costco, and Amazon here, Landon, because it gives us a little bit of context to, how different, companies that are sort of operating in this space are faring. When we look at Five Below, it's the one to me that seems to stick out the most. And I know we haven't talked about that one yet. What is it about Five Below, which I would imagine is a little bit more discretionary oriented? Is it more that the price point that it's offering, maybe $5, $10 or plus, is seen as just a little bit higher quality? Maybe there's a little bit more margin wiggle room than Dollar Tree, because the Dollar Tree data doesn't seem that great, but the Five Below data seems pretty strong.
Exactly. And you know what we're seeing with Five Below? You're right. I mean, I've been talking about essentials over discretionary, and Five Below is not essentials. It is discretionary. I mean, it's stuff you don't need. But, just kind of like I talked about this with Costco, you go in with an idea of what you want and you walk out with 3 times as much. And that's kind of Five Below's model is come into the store, we'll find something for you to buy cheaply. And what's interesting about it is, yes, it's discretionary, but it's also hitting that trade down category that I was talking about. So a lot of these items that people are going to Five Below for, that's them choosing Five Below instead of Target or Walmart or someone like that. And so that's kind of what's at play. So they're definitely different than Dollar General, Dollar Tree, but they're getting people in the door, and they're actually doing really well on the seasonal categories. Like the Easter data that we've got from them was extremely strong, and so they're trying to hit all the seasonal stuff and get you in and get you spending more $5 bills than you thought you would. And so they're adding 150 stores in 2025. Things seem to be going pretty well. And again, the data on them is plus 17. So right there with Dollar General, those two are kind of at the top, and you saw the rest. Dollar Tree was at the bottom, Dollar General, Five Below at the top, and then all the others kind of in the middle. So we like where Five Below is sitting right now, even though, again, they made a similar run on stock price in the last 2 months. I think low 50s to 115 in 2 months, something like that. So they've made a huge run, but we do see the potential for more as they're kind of filling that trade down need. Again, it's discretionary, yeah, which isn't strong right now, but the trade down is really strong. So where people want to spend money on discretionary, they're moving down into the Five Below category and getting their needs met there.
Also seems to just like a stronger e-commerce offering in general. Just the experience, I think, makes a little bit more sense for a Five Below than Dollar General, let's say. Dollar General, like I said, more rural convenience stores, tons of scale in terms of sheer number of stores. But when it comes to online, I think it's actually shocking to see that their web visits is growing that fast from a Dollar General standpoint. All in all, though, not surprised to see Walmart on here. Walmart seems to almost be a barbell of its own. I want to get your Walmart thoughts because they're obviously AI investing in terms of efficiency. They're going to be a name that can benefit if there's autonomous shipping and things down the line. Huge merchandising, tremendous presence in terms of scale of stores, and then there's this double down on e-commerce that they've made over the last 5 or so years seems to be working out tremendously. What are your Walmart thoughts? I know it's run a lot, but it's like nothing's in their way, it seems.
I agree. I think they kind of got out of their own way as well. I mean, when we used to talk about, Walmart versus Target and Costco and all those, it was, Walmart had a stigma on it about consumer happiness. It always trailed the pack with consumer happiness, but that's not the case anymore. I think a lot of that has to do with the online presence, because all of the negativity that we saw on consumer happiness was store related, and they've cleaned up the stores. I think they've made it a better experience, but a lot of people aren't going to the stores. They're just ordering online. And so what we've seen with them, just like you talked about, I mean, the scale that they've got and the fearless innovation and investment into technology just tells me that they are really moving forward, and this is a behemoth that you don't want to be on the wrong side of. So Walmart, I think, is a fantastic own for a long time. I'd be willing to buy shares and throw it in the lockbox. But what we see is it's just really kind of separated itself from the other, like the Targets out there that are trying to compete but have fallen behind for various reasons. Walmart got out of its own ways, creating a better experience for its consumers in store and, more importantly, online, and sort of reinventing itself. But not with too many changes. They're still using all of the huge advantages, economies of scale that they've got. So I'm pretty bullish on Walmart long term for sure.
Yeah, and the omni-channel of curbside pickup, I think, changed the experience. But you think about what Amazon's done to build this logistics network out and having to pop up warehouses and fulfillment centers. Walmart had that with all their stores already built. All that network was there. It was just leveraging it into e-commerce. So super impressive stuff. I love the breakdown. A ton of names that we looked at there. We got to leave it there. Landon Swan, co-founder of LikeFolio.com. Always great to get their data.